So the big question, if you were an investor, why would you buy a bond? Okay, you buy a bond for many reasons, alright? You would want to diversify, okay, your portfolio. So other than just equities, you would like some other asset classes, which can be bonds, okay? And remember that bonds, they have lower risk than equities, okay, but yet they also have higher return than savings accounts or fixed deposits. Okay, you stand to gain regular income, which will be pretty useful. For example, you might use the regular income or interest from the bonds to pay off some other regular interest that you have to pay off, for example, a car loan. Okay, and also a bond would have a market price as well, which leads to potential capital changes or growth. Alright, growth. Of course, there's a potential capital decrease as well, and also it's a useful tool when you're planning for retirement. Okay, because for retirement, alright, you cannot afford, you do not want to lose your principal. Okay, principal, you want your principal to be guaranteed, and bonds have this commitment where they pay back the principal. Okay, so for a retiree, they cannot afford to lose this principal. Okay, and also because it's lower risk. And also bonds, they come in different time horizons. Okay, different time horizons. You can have a bond of like 2 years, you can have a bond of 5 years, or you can have a bond of 20 years, for example. So you can fit the different objectives that you have. Say, for example, you might want to study for MBA, okay, in 3 years, and this MBA course would cost quite a bit of money, and you cannot afford to lose this money in stocks. Okay, so you might want to invest in a bond that has a maturity of 3 years. Alright, so essentially you can meet your financial needs with the different bond time horizons. Alright, so as long as you have a specific purpose in a particular time frame, okay, you can buy a bond to match the time frame. Okay, maybe a study course for yourself, or for education for your children, in which perhaps you buy a 10-year bond or 20-year bond. Okay, or you want to pay money for a particular project in a certain number of years in the future. So typically, as we age, let's say we are at 20 years old and we age until, for example, our 50s, alright, okay, typically, so what we have is 30 and 40. So majority in our period where we're about like 20 to 30 years old, we would probably have a majority of stocks in equities. Okay, because what we think is that we can afford to lose this amount of money if because there are substitutes to that. Okay, but in our 40 to 50s, right, for this certain period here, okay, we would have majority probably in bonds, right, where we are more conservative. And in our early 20 to 30s, okay, we are more aggressive and majority in equities. Okay, because we have already mentioned that equities, they carry a higher risk, okay, as compared to bonds.